what should we look forward to in terms of gold. So first thing first, if you can hear me, just put like a smiley face in the chat or type one. So at least I know you all can hear me. So it won't be very awkward later. You all cannot hear. Okay, let's begin. So first thing first, my name is Sam. I am the uh, I'm from the Central Dealing Contract for Difference team. So if you happen to call the dealing hotline, uh, there's a chance that I'll be picking up the call as well. So me and my team manage the Central Dealing hotline. So if you have any queries about CFD or about the webinar, feel free to email us or even call our dealing hotline. So first thing first, is a disclaimer. So any information that's contained in this webinar is provided you as a general information and for educational purposes only. So this doesn't mean that we are asking you to buy or sell any product. So if you want to have get financial advice, please talk to your financial advisor and do your own homework and also make your own judgment on whether you want to enter or exit or not. So in this webinar, we'll be covering the history and use case of gold. As you know, gold has been around for millennial, thousands of years. And why is gold gold, and what gives gold the its intrinsic value? Next, we'll be talking about the supply and demand for gold. So what you need to take note of, who are the players, and what you need to look out for. Next, we'll also be talking about why you should consider gold. Be it you are a trader, be it you are an investor, why should you even think about adding gold into your portfolio? And then we'll be talking about how should we look forward in terms of what is there upcoming that may change or affect the price of gold, the dynamics, and so on. Lastly, we'll talk a little bit about how to gain exposure to gold. So now that you know what gold is, how can be part of the game and get involved in be it owning gold and so on. So first, a short one. What is gold? Gold is a precious metal. It's this shiny thing that even the word gold itself describes the color, where it's a yellowish glow. There's a chemical symbol of AU. So some of the brokers will use XAU or even other kind of terminology to describe gold. Uh, Next is non-reactive, and it shines. So even back in the olden days where they don't know what gold is for, they see this shiny metal in the river and streams, then they will pick it up and they like to collect it even before they even know what it was, before they even know that it was like valuable. And people like to collect these shiny objects. So there's a obsession with gold since the ancient time, like the Egyptians who believe gold is linked to like the sun god. So gold in history has been always have some value, some kind of mysterious uh, value of like a higher power and so on. So it's always seen as a use as a store of value. So gold as a currency. So this is one of the use case of gold as a currency. So gold as the physical currency itself. So there will be like in gold coins, gold bars, and so on. So first thing, why is gold a good use as a currency? So as a currency, you want something that is rare. You don't want something that is easily found. Then then it will make the currency less meaningful or less valuable. So gold in the ancient times especially is something that is rare, can't be artificially produced in large quantity. They can't just suddenly just create gold out of thin air. Unlike other stuff, nowadays currencies are not really easily printed lah. Whereas gold cannot be easily artificially produced, so you cannot just suddenly introduce a whole bunch of supply into the system. there is somewhat finite supply in the world. So, at least, after a certain amount, there's no more. Then it's durable. Means that, gold, you don't have to like, wow, it's not like eggs, you need to put a lot of effort into keeping it. You can, just lay around just as long as, because it's non-reactive, it's durable. If you drop it, it's not gonna change in weight. It's divisible, which also means that, let's say you want coins of different size to denominate the different denomination in the currency. You can do that because you can melt it down, you can strike it, you can mint it into different size coins. So this is something that is very important that, even the modern day time digital gold or Bitcoin aims to become like they want to be divisible as small as possible. So gold, you can do that. You can mint coins as small as you want and as big as you want as well. So next is there's a high value to weight ratio. So there are other metals or other precious stones or metals that are, they fit certain criteria like, it cannot be artificially produced in large quantity. There's a finite supply of them, but they are not divisible or they're not very durable. Then next is the high value to weight ratio. So gold is something that is rare enough, yet can be found in most places in small quantities, and that is when they make into coins, is able to have enough value to justify to so that merchants will bring it around, and it doesn't weigh too much when they want to do trades and stuff. So you don't want a metal that's too heavy, don't want a metal that is light but not worth anything, like copper. That's why gold was like the gold standard back in the day. The pun. And universally recognized because gold can be found everywhere. People know what gold is. So when you bring a gold coin in the ancient times to another country, people recognize, oh, this is the gold. Okay, I know what it is. I will take it as a form of currency. If you have something that only goes to a certain country, the other country don't even know what it is, then it cannot be used as a global currency because people will not recognize it. They don't want why would I want this thing when I don't know what it is? And it's hard to counterfeit, especially with even the Egyptians, they used to put the gold coin into a basin of water and see how much water is displaced to find out the density of the gold. So from there, they can actually read out people trying to counterfeit this. So it's actually quite hard to counterfeit gold, uh, especially back in the olden days. So gold as a currency has come a long way. So from ancient times to Roman Empire, where they actually mean coin gold. But the thing that more recent, or from the 1980 from the 1870s to 1914, is what we call the gold standard. Gold standard means that the currency is backed with gold. That means, let's say, pounds, or back in the day was Germany, France, even the UK, when they print currency, for for them to make people want to know that this currency, this paper, because they were, back then they were using like silver coins and stuff. Then afterwards, they realized that, you know, bring around a whole suitcase of silver coins or gold, all this precious stuff can be heavy, and it's not very feasible, especially when you want to bring big amounts. So they wanted currency, paper currency, and other coins that have some link with gold. So for them to print or to create or to make currency, they usually have to have gold sitting in the vault or what to put value onto the currency. So people will actually, okay, this currency, if I have $100 means I have, certain grams of gold equivalent, so that other people will believe and accept this currency as payment. So at the end of World War II, so during before World War One and World War Two, the gold standard was like the international standard to facilitate not just the currency but also trade. So people who buy and sell from each other, at least they know that that currency is worth money and stuff. But by the end of World War Two, there was a lot of the allies spent the whole world since the World War. A lot of people were spending a lot of their gold reserves to fund the war. So as you know, US was not really part of the war until the last part lah. So they were actually the ones selling the guns to the allies, and in exchange, obviously the US is they're not sure who's gonna win. So obviously they don't want to take too much money in terms of currencies because the currency may not be worth anything at the end. So in exchange, they took in a lot of gold. So a lot of countries actually traded their gold to US as a form of payment to buy their guns and their medicine and food and so on. And because of this, the US actually controlled at a point in time controlled like two-thirds of the world's gold. And because of this, uh, the US have this a lot of gold. They after the World War II, they actually came together in Bretonwood. Actually, it's a lovely resort. Then they came together in the Mount Washington Hotel at Bretonwood. Bretonwood is actually a place. It's a place in US. Then they all came together. 44 allied countries came together and discussed the idea of having a fixed exchange rate because they knew that the war is going to come to an end, and they want the world to like trade with each other because they realized that a lot of countries they want to rebuild. So they needed money, they needed stuff. So they wanted they came together. They want the idea that if there's a fixed exchange rate, it will facilitate and countries will start to trust that their currency is worth so much, so that you will trade with other people. Because during the war, a lot of trade was stopped, embargo, because of war and stuff. But after the war, they wanted a system where people will trust each other and will start trading with each other. And because of this, the idea of a fixed exchange rate was born. And because of this, after World War II, this is an American-led system. So America was in the center of this system. And because of this, they created two uh, international sort of funds. One is called the World Bank, as you may know, and the IMF, or the International Monetary Fund, which helped or in some ways was part of the influence of the global financial crisis, no, the Asian financial crisis, where they helped in certain ways try and save certain countries. And they post-war they kind of did some lending to countries so that they can rebuild at a faster rate as well. So their Bretton Woods system was, as you can see on the right, there's this diagram. So it's basically US will peg its currency with gold, where the gold rate is 35 US dollar for 1 troy ounce, which is about 31.1 grams. Nowadays, we use ounce is 39 point something grams of gold. So, just their system of measurement back in the day. So, US pegged their currency to gold. So back then, gold exchangeable with US dollar, 1 troy ounce is 35 US dollar. Full stop. Then the other countries, these are just some example of the bigger ones, like UK, Japan, Germany, Italy, France, and Canada. They will all peg their currency with US. So indirectly, they are using the gold standard. But instead of the countries holding the gold themselves, US will hold most of the gold, and the other countries will peg their currency with the US. So in the event where their currency is being fluctuated, they will need US dollars to defend their currency. So it's like the reserve currency lah, in a way. So, and because of this, to facilitate international trade, the US allowed to make people buy into this system and to build trust with allies, US allowed foreign central banks to have the interchangeability of US dollar to go. So at any point, if they feel that, hey, the US actually, I think they cannot make it really, or they're gonna break this agreement, they can change their US dollar into gold. Like they don't trust it, they can take back their gold. So, but because of this system, the global reserve currency was the US dollar instead of gold. So he kind of like forced the allies to hold a bunch of US dollars and not a bunch of gold instead. So, Yes. So this was the Bretonwood system back in the day, end of World War II. But it didn't last long, mainly because if you have a fixed exchange rate with around the world, it will be fine if everyone is growing at a similar pace. But as different countries grow at different pace. US had its problems, it's ultra high inflation. Then, if the central bank wanted to intervene, be it to increase interest rates or to sort of influence the markets like they do now, having a fixed exchange rate does not allow you to do that. And because of this, in 1971, uh, there was the collapse of the gold standard, mainly due to President Nixon. So he came out one day, if I'm not wrong, is in August 1971. He came out and tell the world that, hey, you know about the agreement we signed back in the day. Yeah, yeah, yeah. We are no longer allowing the you're no longer allowed to. They suspended the dollar convertibility to go. So he tell the foreign central banks that they have until this day if they want to convert. If after this day, no more. We are gonna take our currency off the gold standard, ending this whole entire uh, fixed exchange rate lah. So basically, they just said that our US dollar is gonna float. It's not gonna be backed by gold anymore. Like we're gonna use gold as the anchor. So that means that US can print as much money as they want. US can do influence the money supply as much as they want. They're no longer hand tight from gold. Because back then, when you have a finite number of gold that you cannot increase at at whatever rate you want, they cannot just print money. Because if they just suddenly print a lot of money, then people will realize that and they will convert their US dollar into gold. Then they will break the system lah. So because of this, they will actually have some checks and balances where or like when your currency is packed with gold, that you are actually somewhat handicapped in a certain way, but it also makes it so that you cannot anyhow spend money, you cannot anyhow print money because you need to honor this agreement where your dollars can change into gold. Then if you cheat, people will just change it into gold because your dollar is worth less. Then I'll just change it to gold. Then I'll just take the gold. So yeah, so this way it will break the system. And one of the other reasons that it broke the system is that by having a floating exchange rate, actually it helps cushion impacts. So let's say one country is buying a lot from another country, then because of this, if it's a fixed exchange rate, nothing happens because everything is fixed. So one just keep buying. But then if it was a floating exchange rate, because of one country buying a lot from another country, the other country's currency will appreciate because the demand for that foreign currency is a lot higher. And because of this, it will balance out. So when one currency is become more and more expensive, their exports become more and more expensive. So people will buy less from them. So it will slowly balance out each other until an equilibrium point. So these are like the markets, the free market itself sort of balancing itself out. But because of fixed exchange rate, this couldn't happen. That's also one of the reasons why. So here we have two graphs. So one of the graphs shows that the US dollar share in global central bank reserve. So back in the day, before like 1945, so this is after World War II, the global about 90% of all central banks reserves were in US dollars. That is the peak dominance of the US dollar. That means any all the central banks were just holding US dollars basically. But then after 1971, you know, the after they took the US dollar took it off, took its own currency off the gold standard, we can see that throughout the years, even in 2024, there has been a decrease in the dollars as a global reserve. Even though there's a decrease, but it's still way more than 50%. Way more than 50% of the global reserves as of 2024. But it's a downtrend. But as of 2024, it's still US dollars. So US dollars, you like it or not, is still the dominant currency, even though they're slowly losing its sort of reserve currency status slowly, but they are still number one as of now, lah. And the foreseeable future until there are shocks. So the previous time that back in the day it was pounds, that was the global dominant currency. What made it from pounds willingly handed to the US was two world wars, World War One and World War Two. Then US came about as the superpower afterwards. Yeah. So unless not hope lah, there's World War lah. But on the right, you can see that the gold share in the central bank uh, reserves after World War II had dropped significantly because currency after that point, right, is no longer backed by gold. It's backed by faith, or what we call fiat currency lah. So they're not backed by anything, just backed by the government or people's belief that it's worth money. There's no gold sitting in a vault somewhere that gives it value. Now it's uh, just by belief or by trust. So we can see that after 1971, the gold as share of central bank reserve have dropped a lot. Okay, next, gold price after Bretton Woods. So before Bretton Woods, or should I say before 1971, it was fixed. Remember, $35. Then afterwards, right, when they let it free float, so gold price is just depending on the demand and supply afterwards. It's allowed to free float, and US dollar start to lose its value lah. Because back in the day, gold is like the anchor. Then now you remove the anchor, wow. And US start to print money or start to influence its own currency base, make the result that gold has went up a lot from like $35 all the way to 500 over dollars, 10, 15, 20 times. But if you can see, right, at 1980 to 2000, right, actually the gold price have dropped. It's a very interesting thing, lah, because during 1980s to 2000, the US was actually experiencing, during that period, quite high interest rates. So this is something we will talk in a while of what are the factors that affect the gold price. Then afterward, after 2000, wow, you see the gold price just one straight line, basically parabolic, keep going up. And this is until 2024. Just today, the gold price reached 3,300. Even more parabolic than this. So now we'll discuss a little bit about the physical gold distribution and the demand of gold. Yeah. So in the world, if you if you don't know, we have about 208,000 tons of gold approximately. Then out of this, 47% is actually in jewelry. So jewelry actually almost 50% of the world's gold is in the form of jewelry. And the country with the most jewelry, I let you guess, who loves gold. Number one holder of gold in the world in a more private setting is the Indian market. Indian ladies, especially, actually owns a lot of gold. If I'm not wrong, it's like 20 over percent of the world gold is owned by them. Because they buy a lot and they consume a lot of gold lah. Because they like gold as a form of jewelry lah. Of course, there are still China, Middle East, and countries that use gold as part of the ceremony, be it in weddings or gifts as a common gift. While in Western countries, that are not so much. Next is private investment. So private investment are like your ETFs, your in terms of like gold bars and coins and stuff that are held by people. Then there is the central bank reserves. So central bank, even though they have been holding a lot of gold back in the day, but actually nowadays they only hold like the world's about 17%. And that involves all central banks. Yes, only about 17%. Then for industrial use, it's about 8% only. So if you say people say go up in price because of more industrial use, not so much. They only use about 8% of the world gold. Then there are some that are unaccounted for private holdings and so on whatnot. So here is a diagram from the World Gold Council. So this shows from 2016 to 2024, or even the latest one should be the Q4 2024 lah. So this shows the demand of gold throughout into they split into four categories. So one, jewelry. Second, technology. It means use case. You see the technology, the darker blue, it's actually very small. They actually, even though yes, they use gold, to in our computer parts as a conductor, even or in spacecraft and so on, because gold is a very good conductor and whatnot. But the use case in the whole demand of gold, right, is very small. So not much influence. Jewelry is the biggest one. Then it's investment and central bank purchases. So here we can see that if you can see my mouse, the last few quarters, we can see that the central bank has been increasing buying and that the investment has also become larger. So people are starting to, buy more gold, be it physical gold or buying gold ETFs or some kind of investment instrument into gold. And the central banks has been buying a lot more. So why central banks has been buying a lot more? If we see at there's an increase if you can observe, right, from 2022 onwards, central bank has been increasing gold buying. So at 2021, central bank, buy very little, almost the same as the technology. But after 2022, right, wow, the central bank just start buying massive amounts of gold. Why? Okay, so why the reason is in US sanctioned Russia in 2022 February. So this when they sanctioned Russia, one very important thing that they did, or one very big thing that they did, was the Treasury, the U.S. Treasury actually prohibit transaction with Central Bank of Russia and impose sanction on their key sources of Russia wealth. What does that mean? It means that they froze the U.S. dollar assets of Russia. So Russia cannot access the US dollar assets, which is usually held with the treasury or the central bank and stuff. So they froze it, not allowing Russia to use its US dollar. So in the past, this is something that this is what we call weaponizing the dollar. So they sort of forced Russia, lock them out of the US dollar or US financial system entirely. So this is a very big thing that even in past wars are not used. Because once you use it, you are sort of like abusing your power as a reserve currency to bully people. It's like, oh, you're not my friend, then, or you do something bad against me, or your US dollar, we're gonna freeze it. That made kind of a rush, make all the other central banks realize, oh no, if next time, right, in the future, if I am not friends with the US, then they might lock out my liquidity to US dollars, or my US dollars that I have in reserve might be used against me. Then a lot of the central banks in the world start to realize, oh no, if they can do it once, they can do it twice. So what they do, they start to diversify out the US dollar. They be like, oh, you know what? I think let's not be so heavily US dollar focused. So they went to, or went to buy a lot of gold and diversify their reserves. That's why we see a lot of huge buying of gold. Even up to now, they are continuing buying and increasing the buying of gold to diversify out the US dollar and start accelerate the process of de-dollarization. Okay, so here we can also observe here is the investment side lah. So we can see that investment side is separated into like physical bars, official gold coins, metal coins, and ETF. So the one that we see the most, right, in the most recent few quarters is the increase in ETFs. So ETFs, because when you buy into ETF, some ETF actually have gold in a vault, be it HSBC vault or other vaults around the world that have gold to back. So that when you buy it, you're actually buying the physical gold without owning the gold itself. So because of this, ETFs are forced to go out to buy the gold. If more and more people buy into the ETF, then they will have to go out to the physical market to buy the gold. So we can see that there's a huge increase in the buying of both the ETF and also the physical bar. So Walmart, if I'm not wrong, is Walmart or Costco uh, started to sell gold bars in their stores. Then it became, because the gold price is going up, it became one of their best selling items in their shop because they decided to sell gold bars. So, and people start to buy these gold bars as a form of investment because they see, wow, the price is going up. Then they go out to Walmart and they buy this, or Costco, and buy these physical gold bars. So now we talk about the supply of gold, which is quite boring. Supply of gold in general is quite steady across the years. Like we said earlier, you can't really artificially create a bunch of gold, even though recently they have a report where they turn lead into gold in the Higgs and Bose super collider, but they can't make industrial kind of levels of gold. So in general, every year they usually roughly do about 1,000 tons of gold, give and take a bit. Then most 74% are for mining operation. That means they have gold mines that they will get gold. Then the last 25 percent or 26% is from the recycled gold. So of course it's from like appliances and stuff that we throw away. Then people will recycle the gold, however small amount, then they'll collect it. Actually, it adds up quite a bit as well. Then it's quite stable supply lah, because opening a gold mine is not cheap, and a lot of environmental factors comes into it. So not everyone can just open a gold mine without easily, and even and as we dig up more and more gold, it's harder and harder to find a gold mine for you to even start building investing money into it. It's not something that you just can solve with money lah. Yeah. So even you have a lot of capital, you may not be able to find a gold mine, especially, and you may find it in a very unhospitable place that you need to take a lot of time and money to even develop it. So why consider gold? So why do people even bother buying gold? It's just this piece of thing, doesn't really do much. But why should we consider using gold? So gold traditionally is used as a hedge. May not be a full hedge, but a partial hedge. Why? So what is hedging? Hedge means that this asset is negatively correlated with another asset. So gold is usually used to hedge against stock volatility, uh, usually hedge against bad news. It's seen as a safe haven. So in if you compare gold against S&P 500, it actually has depends which duration, which time period you see, right? It has a different correlation index. So between 2011 to 2021, it fluctuates between 0.05 to 0.2. So zero means it's not correlated. Negative means it's negative correlated. It means if stocks go up, more likely or not, the gold will go down. And why do you want to hedge? Why are we finding things that one go up, one go down? Why should we do that? Why don't we just buy stocks and everything go up? Oh, why? The reason why is, why do people even bother to hedge? Because by having a hedging instrument like gold, you're able to achieve a better risk versus reward ratio. So when you do portfolio management or you do asset allocation, generally we don't just want to make the biggest return, because usually high return means high risk. We want the best, the more professional people. We want high return yet less risk. So they don't mind not getting so much upside but has less risk. So the drawdowns are lower and so on. So that for every unit of risk you take, you're able to generate more return. And that is why people actually consider gold. So here's a Sharpe ratio. It's just one of the ratio that finance people use to sort of justify why they add gold inside. So here we can see is the portfolio return divided by the standard deviation lah. So it's about this Sharpe ratio shows that the higher the better. It means for every unit of risk you're able to generate more returns. So if you add certain amount of gold, you're able to maximize this. So how much to add? Next question. How much to add? Okay, how much gold to allocate? So it's more of a science, more of an art, sorry, more of an art than a science. Different people say different things. So the World Gold Council say, people should have between 5 to 10%. Ray Dalio, if you don't know who he is, he's a billionaire and one of the CEO of the Bridgewater Associates. His all-weather portfolio suggests 7.5%. Don't ask me why. He just picked the number 7.5. BlackRock and Morningstar usually says that about 15% is where any increase will sort of have very diminishing or no returns, no improvement in the risk versus reward ratio. So they suggest anything below 15, around 15%. This is where it comes down to your risk preference. So some people are more risk averse. So they might want to put more into gold and other form of hedge compared to risky stocks. But if you're more of a risk-on person, then you should still hold gold because it comes with benefits. But maybe you go in the ballpark of 5% or even lower than that. That's fine. But having a bit of it helps your portfolio in terms of the risk-reward ratio. And one thing to take note, gold is not a revenue generating asset. Gold, you like what Warren Buffett say, if you own 1 ounce of gold for eternity, you will still own 1 ounce of gold at its end. That means this gold will not grow. It is 1 ounce now, is 1 ounce 1 year later, and 1 ounce 1,000 years later, it's still the same amount of gold. So it will not suddenly become more. While as if you invest into businesses, stock market and stuff, or buy, let's say you have a store, it can grow, it can become one store, become another store, and so on as it expands. Of course, it can also collapse, it works both sides. But, if you're in a long-term investment, obviously gold, you shouldn't hold too much about it. So that's the reason why you shouldn't hold more than 15%. Okay, so gold is also seen as a safe haven. So, why is it a safe haven? So, what's the definition of safe haven? Mostly it's because it's not linked to any government. So, governments cannot influence the gold price or cannot just suddenly print or ban gold and so on because they are not linked. Third is a inflation hedge because gold physically have a very good track record and in the past was the anchor to currencies like back in the Bretonwood days or even the gold standard days. And because of this, gold has been used as a measure of the price of that currency. Now it's usually on US dollar. So if US suddenly decide to print a bunch of money, gold will go up 100%. Because now you need more of this currency to buy the same amount of gold. Next is there's no default risk. This piece of gold, you don't have like a counterparty that will sort of not pay you your money and so on. Yes. Here we have a quote. Say gold, historically, gold has always been a safe haven against inflation and safe haven in times of political instability. So that is very true, especially during war. Gold people generally don't want currencies because they God knows, when they go to war, one country may not be around at the end. So obviously the currency is not something you want to hold. You want to hold something like a physical asset like gold. Next is inflation, political instability. So this is when people lose faith in the currency, be it because of this one we'll talk more in a while because there's a lot of about US at the moment. Next is a currency risk. So if a currency like China decide to devalue their currency, if you're holding gold, no problem, you're safe. Your buying power is maintained. While if you're holding the currency, then yeah, too bad, you got hit. And it's a hedge against risk asset. So because gold is more stable and a safe haven, generally when the volatility goes up, the gold usually goes up in price. So just a recap up to this point. So we talked about how gold has been a store of value since ancient times. It has intrinsic value. It used to be gold-backed currency, then it became fiat currency like today, where it's more on faith than actual gold in the vault. Gold is denominated in US dollar. So that is something that as of now, that means gold and US dollar is linked. You like it or not, it's linked. If you talk about gold, you always talk about how much in US dollar. So if US something happened to US dollar, you affect gold. So that is something you have to be aware, and they are always denominated in US dollar. Demand for gold is in central bank, jewelries, investment, and so on. Then the supply of gold is in mining and recycle. Use of gold generally is hedging and as a safe haven. So what influence gold price? So the top stuff is war, political instability, inflation, and interest rates. So these two combined is the real interest rate. So high inflation, high interest rate means that the real interest rate actually is may not be as high. So if you just see interest rate, wow, 10% interest rate, but inflation is 10%, right? Technically, real interest rate is zero. So that's something you have to take note of. Next, US dollar strength. So obviously, if US dollar start to strengthen, then the gold price journey will drop lah. Next, risk asset volatility. So usually this is when like market crash, people rush to safe haven, straight away go into gold and other safe haven stuff like bonds and other currencies as well. That and the supply and demand of gold. So here on the left, as you see, gold hit high back in the time of 3,500 as Trump attacks the Fed. So what is this? This is political instability and Trump sort of like playing around uh, with his executive power and trying to test his limits. So obviously this is something political instability where the government start to influence the Fed, which by right the Fed is independent by right. Next, gold hits new record with sticky inflation. Uh, so inflation, as we see above, is also one of the factors. So war and political instability like Russia, Ukraine, India, Pakistan, Israel, Palestine. Yes, these are all the wars, and these wars create conflict. And usually, it will result in gold price going up because people flee to the safer assets. Then for the inflation and interest rates, uh, currently the Fed has signaled that there's no further interest rate cuts. So interest rate act as a alternative cost to gold. So if real interest rates are high, then holding gold is less attractive because gold you don't get thing. You hold gold like you say 1 ounce now is 1 ounce 1 year later. But you hold currency like US dollar, you will receive interest rate. So if interest rate is high or the real interest rate is high, actually people will prefer holding currency over gold because currency you can grow your money. Then the Fed also has been talking about how they need to observe the data, especially the inflation side and the potential effects of the tariffs on the both the job market, the employment rates, and also the price stability. Next, US dollar strength. So as you know, US dollar and gold is always come as a pair. Then of course, Trump wants a weak dollar. Trump has very mixed signal on this. So it depends on which side of the Trump coin you want to believe in. Trump one side say he wants a weaker dollar so that exports of US is much more attractive because now he say people are not buying my US stuff. Uh, Partly because US dollar is strong, then he want to boost manufacturing and exports, so he wants a weaker dollar. But because of trade deficit, they buy more. US buy more foreign goods, so technically that will push down the US dollar. And Trump also wants Fed to lower the interest rate. If you lower interest rate, generally dollar become less attractive. But on the other hand, Trump also wants US to still maintain its reserve currency because when you're the reserve currency, it comes with certain powers and privileges. One of it, like it or not, is your currency will be stronger because people want to hold your currency or people have to hold your currency. Okay. Next, lastly, will be the risk asset volatility. So when there's a spike in the VIX, or the VIX is usually a measure of volatility, especially in S&P 500, then when there's a spike, usually 18 is about quite low lah. Usually when there's a spike, 20, 30, 40, even 80 and so on, especially during kind of crisis, when there's a spike, usually people will flee to risk asset. Then obviously there's a the Trump effect lah. So anytime Trump decided to do some crazy thing, then the volatility will spike and gold price more likely or not to spike up as well. And the supply and demand, the supply is less effective, but more about the demand, where there are more and more interest and also more and more people buying into gold. So who is buying into gold? So here is a survey that on the central banks. How do you expect global central banks gold holding to change over the next 12 months? So there's been increasing positive note on the central banks to increase gold holdings. So even from data, it does show that central banks are buying, especially China and a bit more on the Asian side. They've been buying and diversifying out of the US dollar, and Europe is following suit as well. So in conclusion, with US debt at record high, uh, the Federal Reserve holding interest rates stable. I mean, they most likely say that they won't consider lowering interest rate until September at least. Then the Moody's downgrading US debt, which is a very recent thing. Then there are also potential peace talks. So there's a lot of things and a lot of parts moving in the world right now. A lot of a bit of uncertainty, especially around Donald Trump and his tariffs. Now that he keep asking people to make deals with him and nobody actually making, he never announced much deals. Even the one he announced with the UK is kind of like, more for PR than actual trade deals. Because these kind of trade deals take time to develop. Instead of it's not just you meet him and in 2 hours time you all shake hand and trade deal is done because there's a lot of more things that goes into a trade deal. And then there's the de-dollarization. Uh, with the BRICS coming up as a contender into try and like dismantle the dollar dominance slowly lah. And this kind of thing takes time, especially there's no big catalyst to sort of make this happen over make it a lot faster lah, like the previous time lah. Yes. So the BRICS, but with Donald Trump doing his thing, people are already starting to even his allies are starting to de-dollarize a lot faster than if he didn't do all this stuff. And because of this, there's still upcoming tariff talks. He only paused for 90 days. 90 days is 3 months, so he still have like another 3 years and uh 3 years and if I'm not wrong, 8 or 9 months to go. So there's still a lot more crazy up in store for us. So it's gonna be a wild ride, especially when there's volatility. Gold tends to be the one who benefits a lot, especially now when everything is a big question mark lah. So nobody know, not even Donald Trump's closest allies know what he's doing lah. So due to this, a lot of people might consider uh gaining more exposure into gold. We can see that in terms of people buying ETF and so on. So next, how to gain exposure. So we are reaching near the end already. So how to gain exposure. So first, there is the gold ETFs. So gold ETFs actually like GLD. They actually have physical gold bullions in vaults. So you actually buying the thing is back. Okay, expense ratio about 0.25% to 0.4%. That's actually okay lah. Considering you don't have to deal with storage and buying gold and all that stuff, they'll do everything for you and stuff. But one disadvantage of buying gold ETF is that only can trade during market hours. Because they're ETF, they are stuff traded on the exchange, like US exchange. You only can trade during market hours. And because of this, they tend to gap. So if we see over here, we can see that the opening price is significantly above or below the price. So these are what we call gap. That means there's no price in between. Means one day it ended at $100, next day it opened at 120. So there's no price between 100 to 120. So these market gaps actually creates a lot of let's say you set a stop loss at that level. If the market gap, you will not be filled because there's no price. So because of this, if you're trading gold, this physical gold ETFs might not be the best choice because gold uh, is influenced by on a 24/5 basis. Any announcement or any kind of development in war or terrorists will result in change in movement in gold price. So if you only can trade gold in America market hours, you may miss out on that opportunity. And let's say it's happened in Asian hours, then the you are unable to sort of buy or sell your position. And one more disadvantage of physical gold ETFs is that you cannot short, or it's harder to short sell. So let's say you think gold price is going to drop, but you only can buy, so you can't do anything. So you must wait. So even when it drop, you can't take advantage of this moment when it drop, even though you're right. And that is why I'll introduce you to gold CFD or gold contract for difference. So gold CFD has a much more longer trading hours, 7:01 a.m. to 4 a.m. daylight saving and 7:01 to 5 a.m. non-daylight saving. So this means that they only have 2 to 3 hours that gold is not trading. Because of this, you see, same chart, but here we can see that there is less gapping, less market gap. They are much more connected, and that if you have stop loss or take profit, you're more likely or not to get filled compared to if you buy gold ETFs. On top of that, you have access to 5 times leverage, and this gold CFD follows the spot gold price, so you can have more time to sort of enter in the position and decide. So at any point in time between the hours, you can able to enter and also liquidate your position. On top of that, you can both go long and short. So if you think gold price are overpriced, you can actually put in the short position to take advantage of this scenario. Especially nowadays, gold price has actually become more and more volatile due to the roti prata status of the current global economy. Especially with Trump, one day say tariff, next day say, oh, you know what, we will pause, or I'm kidding, or what, you know. Nobody can trust what he say. One day he's scolding Jerome Powell, next day he say he won't fire him. You know, and because of this, gold price will really whiplash up and down. So after this, we have a promo. So if you want to try trading gold or gain exposure to gold through CFD, good news, we have a promo for you, especially if this is your first CFD account with us. So the promo is as follows. So if you were to trade with us, your first trade with us, you will get $100 cash credit. Then every subsequent trade, you get $10 with a maximum of 5 trades per day. And these trades must be new trades. Liquidation trade does not count, and amalgamated trade does not count. So if you want more information, do scan the QR code. This promotion is until 30th June. So you still have quite a good 1 month and a couple of weeks to do. So if you want to try and gain exposure to gold through ETFs or through CFD, you can start your journey today. So now we have came to the Q&A section. And the account, this is the account opening link if you want to open account with us. Then once you open account, then you can start. You're also entitled to the CFD promo if this is your first CFD account on an NRIC level. Okay, so if you have any question, you can type in the chat or the Q&A. Hey, hi. So if you have any questions about gold or CFD or anything that's covered inside. Okay, we have a question from Tiffany. Hi, if already have a Cash Plus account eligible for this promo, let me go back to the promo. Okay, just as long as you do not have a CFD account with us before, this is your first CFD account, you are entitled. Doesn't matter your Cash Plus, cash management account, okay. Yes, the CFD account is an add-on to your current account. Then yes, so long you have created account, your first account with us, you are entitled. Okay, we have a question. Can use CFD but at 1 times leverage? Okay, the leverage part, right? The misconception is when we say 5 times leverage, it means up to 5 times. Which means if you have $100, you can buy up to $500. But if you have $500, you can still buy $500. Nothing stopping you from buying that. So does have access to leverage doesn't mean must use. But if you're trading CFD, generally people use, but we don't advise people to use the maximum. Just because we allow you to go here, right, doesn't mean you have to go all the way. You can, depending on your risk preference, you can go in between. Yes. Okay. Do I think gold price is continue to rise? Okay, based on talking to some technical analysts and also doing some research myself, uh, it, okay, for fundamental wise, it, judging on Donald Trump's radical behavior, I think fundamentally gold price still has way to go. But if he stopped being so crazy and there's more stability, but I still feel that with his tariffs, he markets haven't priced fully the effects of the tariffs in terms of how it affect the price inflation in US and all over the world. But that's why the current price of gold at 3,300 is quite warranted given that there's a lot more inflation to come, I feel lah, personally, because a lot more people, even Walmart CEO came out and talk about how price increases are to be expected. Even though Trump might, be in denial, saying that they tell Walmart to eat the tariffs, but businesses will still be a business and push the price to the consumer. They might eat a small portion of the tariffs, but trust me, majority is going to the consumer. With shareholders to answer to, the easiest way is just to push it to the consumer. Okay, in next 12 months. Okay. Uh, According to my technical analysis analyst, they kind of like foresee prices to go to even up to 4,000 by the end of the year. But it's still depending on because it's still a very unclear situation, which makes gold very interesting. Because gold, like you say, is a safe haven. So if peacetime, gold should go down. If inflation is not high, gold should go down. So if your view is that inflation is going to spike The world won't be as peaceful as it is, especially the Russia-Ukraine war, is still a big question mark. There's a little bit of conflict, a little skirmishes between India and Pakistan, and this kind of little things happening, popping up over the world. Then generally, safe haven asset like gold will tend to be a good store of value, lah. Like people will place their money there. Yep. Okay, there's an interest rate change, right? At what percent? So I'm not sure what interest rate you're referring to, but for Federal Reserve or US interest rate, that affects US dollar, which also affects gold. Uh, the US has actually been, uh, the Federal Reserve have been holding interest rate steady and not increasing or decreasing. They want to be more cautious. They don't want to decrease too fast, and they want to keep it here so that their dual mandate, which is in keeping price in check, which is inflation, and unemployment low or employment high lah. Yes. Yes. Tiffany, if you have please email us. We can help you check to see whether you're eligible. And yes, no worries. You can email our CFD at phillip.com.sg. Uh, yes, or call our dealing desk hotline as well. So we run 24/5. So from Monday 5 a.m. to Saturday 5 a.m. You call anytime. We have someone to attend to you. If you cannot get your call through, most likely we are already talking to a other client. So please be patient because we don't have the most manpower. Yeah. Okay, let's see. Any more question? Okay, CFD, what are the charges? Okay, that's a good question. So for CFD, if you're trying to trade gold with us, we have two types of contract. One is $1 per point, one is $100 per point. So what $100 per point means that for every movement in gold that's $1, you'll gain or lose $100. So it's 100 times the size. So that is for people who want to buy 100 size. So if you don't want to buy so big, you can buy the $1 one. That means, let's say it's $3,300. You buy that means you're being exposed to $3,300 US dollar worth of gold. So that's 1 to 1. 101. So we have these two contracts. Then on top of that, the fees. Okay, hang on. Let me help you search. Okay, so these all the fees, right, are all in our website. Okay, let me see. For our gold contract is one US dollar per lot for the US dollar one. And the US dollar 100 one is 5 US dollar per lot per site. That means if you buy, let's say you buy one gold US dollar one and you sell it, it's 2 US dollar per lot per site. Yes. So it's 2 US dollar in you buy and then you sell. Then net $2 US dollar. Yes. Then for the finance charge, which is also another cost, is 8% per annum for if you're long. If you short, is 5%. And this is a year. Usually people don't hold a year. And I don't advise people to hold CFD for a year. CFD is more used for shorter term hedging and so on. Yeah. If you want to hold the gold in your asset portfolio asset for longer term, then I actually will advise you to buy ETFs. Because ETFs, their expense ratio is 0.25 to 0.4%. So if you're holding a year, you pay 0.4, I think that's fine. But as an investor, I think paying 8% a year is quite a steep price. So, CFD more for trading. If you're an investor, you can consider ETF. Okay, can I elaborate more on CKA? Okay, CKA is Customer Knowledge Assessment. So this is a currently a must-have if you want to trade CFD. So CKA if you haven't, okay, so there are CK is so that it's MAS regulation to make sure that people who trade CFD knows what CFD is. So it's like a knowledge test or yeah, to make sure that you know what it is, especially if you do not have a degree or any work experience in the finance industry. So there are some exceptions. So if you have traded CFD before with either other brokers or whatnot, or you have a finance degree or working experience in finance, then they kind of assume that you know what you're doing. So your CK technically is passed. But if you do not have these requirements, no worries, that you have to take a test. So this test, first you fill up the questionnaire lah. So there's this questionnaire to sort of ask you a few questions. After the questionnaire finish, then they will say, oh, you are not qualified to have an automated pass for CKA. Then you will take the test. You need to take a test. So don't worry, there will be links there to guide you on the test, and there will be obviously the lesson and then the test. So this is to protect retail investors to know what they are trading lah. Because we don't want, I also don't want you to trade CFD if you don't know what CFD is. Because I always believe that you should know what you're buying and what you're selling, so that so you can make the best informed decision. We're not here to take advantage of people who are not aware. You can also ask us what is CFD. We'll gladly tell you more. And also we have webinars to guide our investors and our traders and our clients into to know more about CFD and to know whether it's for them. To be fair, CFD is not for everyone. Even though yes, I'm a CFD dealer. I have incentive to I tell everyone CFD is for everyone. No, CFD is not for everyone. But CFD has a lot of use case that a lot of people can take advantage of. Yep. So if you are more risk averse person, like taking risks and overloss, potential overloss is not a risk you want to take, then CFD is not for you because CFD uh, has leverage, inbuilt leverage inside. So there is a chance of overloss. Yep. But if you want to use CFD responsibly and to use it with a risk management strategy, then of course, CFD can bring a lot of benefits, a lot more opportunities for you to take advantage of, especially from shorting to longer hours of trading. Yes, so you can get into position anytime you want, or most times, more time than you want than if you do not have access to CFD, especially during market volatile market times. Yep, I see that we have overshot a bit. Any last questions, or else we can call it a day. And thank you everyone for tuning in. And I hope to see some emails if you're interested to know whether you're qualified or more information. You can always email us or call our hotline as well. Anyways, thank you everyone for attending this webinar, and I hope you have a great evening. Thank you.